Now I want to talk to you about a home refinance or a mortgage refinance, which is, in my opinion, the most dangerous type of consolidation that someone can do. Okay? So we're talking about debt. We're talking about credit card debt. So we had our credit card companies, right?
Mm-hmm.
We had our credit card companies, and then you have to pay this down. And again, credit card debt is short-term debt, so it's designed to be paid. It should be paid in the month or 3 years or less, right?
Mm-hmm.
And the consolidation, because it goes longer, consolidation can go into 10 years. That makes it more expensive, but it shrinks the payment. Now, what I want you to understand is, I'm going to show you here, I made this brick, and this is going to represent $30,000 of credit card debt. $30,000. Now, what a lot of homeowners are going to be facing, especially coming out of a recession, if there's time where they're making less money or hours are reduced and they end up having to borrow or use credit cards and create debt, they're going to get a lot of offers. They're going to get a lot of solicitations, which is a big word for offers, in the mail, or they're going to see it on TV or on social media for them to refinance their houses and consolidate their debt and take that heavy credit card debt, right? Oh, you don't have to deal with all those payments. That's so heavy. That's too much for you. Take that heavy credit card debt and roll it into their mortgage. And why would somebody roll into their mortgage? Well, because a mortgage, if you're paying down your house, you're building up equity.
Mm-hmm.
What's equity? Equity is a savings of value in your home. So when you're paying down your house, the value that the house has above the balance that you owe on it is called equity. So it's like a forced savings. So now we're going to have a lot of ads on social media and on the radio saying you can refinance to get rid of all those monthly payments and get it into one. But what I want to share with you is that I'm going to say this is $30,000 of credit card debt. When you take debt and you put it into a 30-year mortgage, your payments will go from 3 of these to 1 of these, which looks fantastic. Like, wow, what a big difference. But in the process of consolidating the debt, you're going to pay 1.5 times the original amount that you borrowed in interest alone. So if you put $30,000 into a 30-year mortgage, you're going to pay back 30 plus 15, $45,000 of
extra.
Yeah.
So you're going
extra.
to end up paying $75,000.
Yes.
And you ain't got that money.
So your $30,000 problem turned into a how big of a problem?
$75,000.
$75,000 problem. But the ads on social media and the ads on the radio aren't going to say, hey, we want to charge you 1.5 times your problem.
No, we're going to reduce it is what they're going to say in Turkey.
We're going to reduce your monthly payment, right?
And make things so much easier.
So this strategy, this refinance, this consolidation works for some people, but only when they have a plan in place and a discipline to keep up after this type of consolidation, a very aggressive payment plan. If they don't, and they just go and they just chase a smaller payment, this ends up being a lot more expensive. Not to mention, immediately, the fees, because the bank's not going to do this for free. They're going to say, oh, let's give us your problem, we'll take care of it. We're going to add, right away, we're going to add our fees. And then over time, you're going to pay interest on top of that.
So it's like, so you have all these spoons, and they're all here. And then you have this, and then they take all these out and take it to that. Like he said, that would be say that's $30,000, and then plus another $30,000 and $15,000. You'll end up paying $75,000. So you really should just pay all these, because then it'll end up being less.
So you should, yes, so you should be paying these. It'll end up being paying less. But in order to do these correctly, we have to look at our whole household budget, the money that's coming in, how we're managing those dollars so we get the maximum benefit and we're not pushed into a situation where we feel like this is our only option.
And then it can also get worse because the interest isn't you, if they're adding your credit card debt to it, it isn't you going and buying more clothes, buying more stuff. It isn't adding all those other things that can make it even bigger.
Well, after your consolidation, can people still use the credit cards again?
No.
So if we're not addressing the budget problems and we do a consolidation,
I can
then
be spending money and just gaining and
we can
gaining.
create more debt on this credit card, more debt on this credit card, more debt on another credit card, right?
Yeah.
And that's
Do
the
it
danger.
all over again.
This is the danger. So the idea is to look at the budget carefully, to understand and make sure that we're getting maximum control of every dollar that comes into the household. And I'm going to tell you that the majority of the time, that's enough. That's enough to avoid having to do something this extreme and this expensive. Anything else?
No.
All right. When you're when you're given the opportunity to be right
or kind.
or be kind, always choose
Be kind.
be kind. We'll see you next time.